Welcome to another edition of our Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, the election has come and gone. We have had a great year up to Election Day, a plus 22.6 through November 5th. Got the Fed cutting interest rates, fairly strong economy, but a huge response to the Republican sweep of the White House, the Senate, and the House. We saw the fourth largest Dow Jones Industrial Average jump in a day. And by the way, that's not even typical. In fact, only 40% of the time is the market up a day after, the day after the election. So seemingly Wall Street encouraged by what they expect to be or see in the way of tax cuts and less regulation, cheaper oil and gas and energy prices, lower interest rates, lower cost of borrowing. Bonds have seen huge outflows, presumably safe money coming off the sidelines and going into stocks. The S&P was up 2.5% in a day and set a new all-time high. It's the 25th time we've had a new all-time high and it be on a daily jump of more than 2%. And when that has happened in the past, the median return 6 months later from that point is another 9.5%. And 12 months later, a year later, the median return is another 12.4 actually percent return. In other words, better than normal returns. And the best 2 months of an election year are November and December. So, party's not over yet. Now what, right? Okay, now what? Well, this election decision is likely polarizing. We've got half of this country that is thrilled, and the other half whose mind is blown, and we've got folks shaving their heads and ordering handmade costumes and moving to Canada. Okay, as the steward of your assets, my job's not to get worked up into a tizzy over politics and over election news and rumors, but to do the best thing for you and your money. In fact, 4 years ago, I heard a whole lot about that this was the end of this, and the end of that, and what in the world have we done, and what's gonna... And things haven't been too bad. Now, there are obvious challenges this go around. Okay, the transition of power, the appointment of the cabinet is likely to take center stage here for the next couple of months. And we've already seen some volatility with that. Big Pharma and Robert F. Kennedy Jr. The Russia-Ukraine concerns, again, just freshly renewing themselves today and yesterday. Now, of course, who is in the White House matters. But some things matter more for investors, like the economy, Fed policy, inflation, valuations, earnings, market trends. Okay, right now, the economy is outperforming. And there's really no signs of it slowing down. Productivity is at some of the highest levels we've seen since the late 90s. We have a stable but slowing labor force, and earnings are at record levels. Now, let's glance a little bit at history. The S&P looking at back-to-back 20% gains. Years, back-to-back years with 20% gains. 26% last year, 25 and change this year so far. We've got a little bit to go, but 25 so far. 4 previous times since World War II has the next year done, the next year followed, okay, and what returns have we seen? Following 20% plus years, okay? Listen to these numbers. +2, +31, +28, +19. What do you notice about those numbers? First of all, they're all positive, right? And secondly, there's some healthy numbers in there. Okay, now, sure, there are reasons to be cautious after a great run like we have seen. But stocks up the last 2 years in a row shouldn't be one of those concerns. Now, how did various sectors of the market perform in the last 2 presidential terms? And remember, one of these we've already seen before, 45 and 47 now, right? Well, under Trump's first term, technology was the best performing sector. Growth stocks, consumer discretionary was actually the 3rd best performer. So those kinds of companies where when we have extra money, when the economy's healthy, we have extra money. Entertainment, travel, hotel, shopping types things, okay? Those are the sectors that did pretty well. The worst performing sector of the market, energy, oil and gas. Now under Biden, what were the best performing sectors? Interestingly, energy, oil and gas was the best performing sector, followed by technology, and then financials, banks, insurance companies. What was the worst performing sector? Bonds. Bonds just got hammered under this current presidential administration. Worst performing sector. So where are we now? S&P, let's take a look at the last 5 years even. The S&P is up, believe it or not, 100% since 2019. Now, think of all the reasons that we have had to sit on the sidelines, to be nervous, be scared. We had a global pandemic that shut everything down. We had an election that many would say maybe didn't go the right way, and all these things are gone, okay? We had war in Ukraine. We had ridiculous inflation, which we really haven't seen in the last 40, 50 years. We had huge deficits, mounting national debt. We have another election, okay? So many reasons to pull back, to sit and be conservative, to not invest, to not participate. And yet, what's happened? A 100% return since 2019. And why is it up? Because profits are up. And profits are what drives markets. Well, happy Thanksgiving to you and your family. I hope you get this holiday season kicked off well. I want you to know that you are among the many blessings that I and my family count through this Thanksgiving season. 21-year-old financial planning major, senior at Texas Tech, Corey, could not have dreamt that I would have it this good. So thanks to you. Know that you're a blessing to be able to get to do what I love, what I enjoy, and do it with great people like yourself. Clients that are not just clients, but are also friends and even like quasi-family. Thankful, so thankful for you. Happy Thanksgiving, and we'll talk to you next month.